So I'm Dan Coatsworth. I'm the editor of Shares magazine. Before I start the presentation, get the boring old disclaimer out of the way. Effectively saying anything I say today is not investment advice. It's very important for you to go and do your own research here. You know, the value of any investments you make can go up or down. You may not get back any of your original investment. Just remember that past performance is not necessarily a guide to future performance. Okay, so gone from drugs. I'll talk to you a bit about booze and other likes. So really, there is an important reason why I wanted to look at the leisure sector today. Consumer confidence in the UK is actually at a 15-year high. That's a really important statistic. Market research group GfK says that Britons are the most upbeat about their financial prospects since the year 2000, thanks to low inflation and a pickup in wages. Now, if consumers are feeling happy about their finances, pretty much means that they should be secure about their jobs, and they're willing to spend more money than just paying their bills and their mortgages. Now, if there's one place that's going to benefit, I'd say it's going to be the leisure sector. We all like a treat. Pint down the pub, nice meal out, trip to the flicks. You're always going to be high on the list of things that you're probably going to do first if you've got a spare bit of money in your pocket. Now, this isn't a one-way bet that stocks are going to rise in the sector. Actually, if you looked over the summer, the food, drink and sort of associated leisure sector actually struggled a bit because people went on overseas holidays. And you just look at results recently from Whitbread, they'll tell you they had a bit of a tough time. But you know, really, I think that's just a short-term issue. Long-term, this is a really, really interesting sector for investors to look at. Now, I've been writing about the stock market for 10 years, and I invest from time to time. The leisure sector is pretty much the place I always start looking for things, if there are any opportunities. You know, I like the fact you can interact with the brands. You can go to a pub or restaurant. You can see yourself if it's busy. You can see what type of promotions they're doing. You know, if there's no sort of big discounts, you know they're pretty much going to be doing well. You know, you just have to read the newspapers to see what the latest trends are. You know, look at the rise of craft beer. I remember talking to some of the big pub operators a few years ago, and they said, "Oh, it's just a fad." But actually, these craft beers are in all the high streets now. They're in all the pubs. They're actually a driver for people to go and test them. So really, as an investor, you've got to be one step ahead of the game. The best money is made by owning the shares before a positive announcement is made. Now, of course, we don't have a crystal ball, but there are signs you can follow, which can see if someone might be going to report something pretty interesting. Now, you've got to remember that if someone issues an RNS announcement, which is a regulatory news service, on day to say, this is a trading update, we've had a great sort of experience in the last few months or 6 months, the share price will automatically adjust before the market opens. You probably missed it. But really, if you go away looking for signs that might hint what could come up, that will perhaps put you in a better position. Now, over the summer, I was chatting to some colleagues in the office about Goal Soccer Centres. And this is a company that's on the UK stock market. And I took my daughter to football training one Saturday morning in Beckenham, and it was held at a Goal Soccer Centre site. I couldn't believe it. It was an absolute mess. The place was empty. The only thing going on was the kids' football training session. All the signs saying what was going on, they're all fading away, paint peeling off the wall. And I went back to the office next week and I said, I bet you next time this company has a trading update, it's going to be rubbish. And I don't know if anyone follows this stock, but last week they had a profit warning. Said the UK trading was awful. And it really didn't take much to see that sort of sign. And it's these little nuggets of information that can help you identify the right trades to make. So on the stock market, you've got a lot of names that perhaps you're familiar with people. We start with restaurants. You know, actually, these have been really great investments over the years, and they all pretty much generate lots of cash, and that helps to fund their own growth. You know, unlike something like pharmaceutical, biotech, or sort of software, these aren't companies that continuously go back to the market asking shareholders for more cash all the time. They're self-funding their growth, which is a fantastic situation to be in. And of course, private equity companies are fully aware of this. They're there waiting to gobble them up, because actually they could probably use cheap debt to buy these companies, and the free cash flow from the restaurants themselves, more than pay for the acquisition cost. So in the US, I don't know if you've looked at stocks there, over the last few years there's some fantastic IPOs that have done so well, all related to the restaurant sector. Shake Shack floated January this year. It's consistently beaten earnings expectations since being on the stock market. Actually, on the first day it traded, the stock price more than doubled, and it's risen even further since. So in the UK, I've been reading about D&D restaurants. There's rumours that this is going to float in London soon. It's founded by Conran, owns lots of well-known restaurants in the capital. Quaglino's, Coq d'Argent, Paternoster Chop House. Yeah, these are quite high calibre names. We haven't had anything like this during the UK stock market for a while. So I reckon if this IPO goes ahead, you're definitely going to hear about this, and I'm sure there's going to be a lot of investors interested in it. But, and there is a big but, the issue to consider with restaurants is the pace of expansion. And I get an email every day from a trade news service which talks about companies, not just on the stock market, but just private ones as well. And it's all the same story. It's expansion, expansion, expansion. Do we really need all these extra restaurants? I live in Bromley, and that's full of restaurants. But I know of 2 retail developments close to the high street that will house yet more restaurants in the coming years. Now, the story has got to be the same in other parts of the UK. And market saturation is definitely something you have to be aware of. I don't think we're at a danger point yet, but don't ignore the threat. And one analyst said to one of my colleagues, there is a clear way to play this expansion theme, and it's via a stock on the UK market called Churchill China. It provides the plates for the restaurants. So if we're all going to expand, we all need something to eat off. It might be one to research further. But really, if you're going to invest in the leisure sector, pick stocks with top quality management and a unique selling point. So I don't know if you know of a stock called Restaurant Group. It owns Frankie and Benny's, which is very well known, particularly family favourite one. And it's done really, really well on the stock market. Investors have recognised it's got a competitive advantage. Most of its sites are located on retail parks. Now, there's a restriction over the number of restaurants that are allowed on retail parks. Therefore, that means minimal competition. It made the decision years ago to exit the high street because it was so easy for a rival to come next door and just set a restaurant up. And therefore, it got instantly killing or oversupplying the local area and adding to competition. So I don't know if you can see that properly, but this is Fulham Shore. So this is a company that was on ISDX. It joined AIM fairly recently. So a few weeks ago, I went to the West End to just visit a friend who'd come over from Australia. We went to Covent Garden to try and find something to eat. There's loads of restaurants there to choose from, but there was only one that had a queue out the door up the road. Now, I don't know about you, but I've always been told if there's a queue, that's a very good sign, decent place to go. So as I approached the site, I noticed it had the sign, it said Franco Manca. I thought, okay, that's interesting. It's a sourdough pizza chain which was recently bought by Fulham Shore. So Fulham Shore is quite new. Most people have probably never heard of it, but you will have heard of the people that run it. So the boss is David Page. He built Pizza Express. He also struck gold again with Clapham House. This used to be on AIM, and it owned Gourmet Burger Kitchen, and that was gobbled up a few years ago by, I think it's people that own the backers of Nando's bought it, Capricorn. But you can see the share price here, Fulham Shore. It's been a very good investment for people who got in early. Valuation-wise, it's quite rich, but the Franco Manca brand, certainly something to keep your eye on. And I would expect Fulham Shore is not going to be a one-brand business. I mean, they've got the Real Greek as well, but I think one to keep your eye on is this one. Pubs. I'll give a quick mention to the pub sector. Actually, the shares tend to move a bit slower than the rest of the leisure sector, but they are considered decent long-term holdings by fund managers. The Marston's is a real favourite for pensions funds. It's got quite a lot of debt. It's backed by freehold property. So I don't even see this. It's the Bat and Ball. This is a Fuller's pub, I think. Fuller's is a fantastic business. High quality products, great attention to detail. in all their sites, really well maintained, and you want to go there. I mean, that's it. You know, people talk about Wetherspoons, it's cheap, but do we really want to go there? I would like to go to Fuller's, and I also like to go to Young's pubs as well. So Young's is on AIM. It's a great, it's got no, it's unashamedly premium price, and it never hides this. Its profit margins are much better than the rest of the sector, I would have thought, given that it charges so much more. It's a great quality pub sector in the sector. But actually the dog of the industry is really Mitchells and Butlers. So it owns Harvester and O'Neill's. They're known brands. But having a well-known brand doesn't mean to say that lots of people are going to go there and they're going to make loads of money. So he's got a guy who used to be high up at Marston's, has gone in. He has yet to turn the business around. I mean, personally, I just don't think its proposition stands out from the crowd. So on cinemas, very resilient. You notice those over the recession. Everyone still went to them. I mean, you look at VHS tapes, DVDs, online streaming, all these thought to be disruptive forces, many feared would kill box office takings. They haven't. And I think everyone loves to go and see a film on the big screen. Like, nice sound system. We all like to sit in the dark, escape from the troubles of everyday life for a few hours. For the young and the old, so the multi-generation customer base provides a solid market for cinema operators. So on the UK market, we've got two stocks that are relevant. The big one's Cineworld, the little one's Everyman Media. I mean, I don't know if you walked up from along Upper Street, I think Screen on the Green. I don't know if someone might correct me or not. I think that might be owned by them. Well, it might not be, I'm not sure. But really, so Cineworld is the big one. It's got operations in UK, Ireland, Eastern Europe, Israel. It's been a really good investment. Now, I've written about this in Shares magazine. Hopefully some of you are subscribed to it. A lot of the time, there's been real potential for profit growth. And it was really, really obvious. You could see this before the share price moved. To me, that the signs were so clear over the last few years that things were going to go up. I mean, I wrote about this on many occasions, saying you had new management aggressively buying shares in the market. It's always a bullish sign. Secondly, consumers are happy to pay a premium price for great service and comfort, and Cineworld has an upmarket chain within its business. Thirdly, the cinema release schedule this year has been the strongest for I just don't know how long, and this is something that investors could have spotted early last year. All these big films that are coming out this year, all the releases were confirmed, and they're all part of huge franchises. So we've got Star Wars, James Bond, they're coming up very soon. The Despicable Me spin-off Minions has just come out over the summer. Another Fast and Furious. Jurassic Park, that's been an absolute stonker at the box office. And if you look at this, look at the end of 2013, 2014. Not much movement there. It was only towards the end of the year, and particularly this year, that people really caught on to it. Now, analysts were late, in my opinion, in pricing in the potential profit from the films that are coming out this year into Cineworld's earnings forecast. So actually, there was a long period that you could have bought the shares before the re-rating that you've seen this year happen. Now, the trouble is, for investors who aren't in the stock now, you have to ask yourself, is all the good news priced in? I mean, Star Wars is not out yet, nor James Bond, but actually there's a potential, if Star Wars works, it's going to be multiple visits by people to see that over and over again. So who knows? I'm not allowed to give my thoughts today because anything construed as investment advice. But I would say it's something to think about with stocks that you really need to be in before news comes out. The stock market is all about pricing in expectations for future earnings. It's not historic. Crowdfunding. Now, hopefully you'll all have heard of crowdfunding, and I thought it was relevant to bring it up in the presentation today. There's a growing number of platforms in the UK trying to match companies seeking money with individuals who want to invest. On the whole, these aren't companies looking for money that are on the stock market, so they're private businesses, but a lot of them are in the leisure sector. They're sort of wannabe cool restaurant brands looking to open their second or third site. There might be some breweries wanting to expand operations. So you've got two choices really. You either have mini bonds, where you lend money in exchange for a fixed rate of interest, the level of which often depends on whether you want some money off in these restaurants over the term or straight cash return, or you buy equity in the business. But I have a slight problem with the latter bit, in that They don't really have an exit mechanism, or certainly not a clear one. You're buying shares in a private company. You cannot go onto the stock market or your share dealing account, your ISA, your SIP, you cannot sell them. So we now have a situation where people are being overpaying for an illiquid investment because the valuations of many of these equities and the crowdfunding platforms have been ridiculous. Mini bonds, you may view this in a different situation. This is you lending money and getting regular cash payments back. So you have to consider, is this company I'm lending to good? Is it going to be able to repay the money that I've lent them? You may get your first year's interest back. You may get your second interest back. But what happens if it's going to, will the business still be there at, say, the end of the third or fourth year? It's easy to open a restaurant. It's easy for them to go bust. There's Brewdog, Square Pie, some popular names. They've all got offers out, worth having a look. Anyway, thank you very much for listening to me today. Come and visit on the share stand. Please read shares. We write a lot about leisure sectors. Thanks very much for your time.